So, what if I told you the hardest part of investing has absolutely nothing to do with picking the right stocks or timing the market? What if the real challenge is actually something much, much closer to home? Well, stick with me because over the next few minutes, we are going to completely transform how you think about your money. And, this quote from investor Barry Ritholtz it hits the nail on the head. He says, investing is a solved problem. We've got tons of data on how markets work. The real variable, the wild card that we just can't seem to figure out, it's our own behavior. Yeah, the biggest risks to your financial future isn't the market, it's the person staring back at you in the mirror. All right, so let's dig into this. To really get why we are so often our own worst enemies, we've got to look at the tool we're using for all these decisions, our brain. And here's the picker. Our brains are incredible, they're brilliant, just, not for this particular job. I love this way of thinking about it. You know how in the medical world they talk about using a drug off-label? It means using it for something it wasn't originally designed for. Well, guess what? When we're investing, we are using our brains completely off-label. They just were not built for Wall Street. And this really lays out the fundamental problem, right? For literally millions of years, our brains were wired for one thing: survival on the savanna. That means being primed for super quick action, being hyper-aware of every potential threat, and, of course, finding safety in numbers, in the herd. But successful investing, it demands the exact opposite. It needs patience, it's driven by cold, hard logic, and it often requires you to be independent and stand apart from the crowd. So who's the culprit here? Well, we can actually point a finger at a specific part of our brain: the limbic system. This is the ancient, primitive, emotional core. It's the part that screams fight or flight when a lion jumps out of the bushes, or, when the stock market dips a little. Wow. Okay, so Dr. William Bernstein, who's both a neurologist and an investor, really doesn't mince words, does he? Learn to control your limbic system or else you will die poor. This isn't just some fun factoid. He's telling us that mastering this part of your brain has very real, very direct financial consequences. And that pesky limbic system, it unleashes our two biggest enemies when it comes to money. First up, you've got fear. This is what makes us slam that sell button at the absolute worst possible moment. Think March 2009, right at the very bottom. And then there's its evil twin, greed. That's the FOMO, the fear of missing out, that drives us to pile into whatever's hot right at the top of a bubble, just seconds before it all implodes. Okay, so if our brains are basically hardwired to make us lose at investing, then how in the world do we win? Well, we have to change the game we're playing. We have to stop trying to play against the market and start playing against ourselves, against our own worst instincts. And this leads us to this absolutely brilliant idea from investing legend Charles Ellis. He called investing a loser's game. Now, what does that mean? It means the goal isn't to be some genius who makes these amazing, incredible moves. Nope. The goal is way simpler. Just make fewer dumb mistakes than everybody else. The best analogy for this is tennis. Think about the pros. Pro tennis is what you'd call a winner's game. Points are won with these incredible, powerful aces and perfectly placed shots. But then you have amateur tennis, the kind you and I might play. That's a loser's game. The match is almost always lost by the person who makes the most unforced errors, right? Hitting the ball into the net, hitting it long. The winner is just the one who messes up less. And let's be honest, most of us are amateur investors. We win by just avoiding those stupid, unforced errors. So you still think you can win the winner's game? You think you can pick those rock star stocks? Well, listen to this. A famous study found that just a tiny fraction of stocks, 2% to be exact, are responsible for all of the market's long-term gains. 2%. The odds of you consistently finding those needles in a giant haystack are, well, they're not great. And if that doesn't convince you, how about this? Look at the pros, the people who do this for a living. Over a 10-year stretch, more than 90% of professional fund managers fail to beat the market. I mean, if these guys, with all their resources and fancy degrees, can't win the winner's game, what on earth makes us think we can? All right, so we figured out the problem. It's our brains. And we have our new goal, play the loser's game. So now the big question is, how do we actually do it? Let's get into a simple, practical playbook you can start using right away. The beauty of this winning playbook is that it's all about simplicity and discipline. Just 4 steps. That's it. Step 1, automate your process. You want to take your emotional brain out of the driver's seat. Step 2, diversify broadly. Own a little piece of everything. Step 3, minimize your costs. because fees will eat your returns alive. Guaranteed. And finally, step 4. And this is the hardest one for sure. Stay the course. I absolutely love this quote from Nobel Prize winner Paul Samuelson. Investing should be boring. He says it should be like watching paint dry or grass grow. Seriously, if you're looking for excitement, go to Vegas with a few $100. Your actual investment portfolio, it should be so boring it puts you to sleep. Because that boredom, that's the sound of a winning strategy. And speaking of diversification, the founder of Vanguard, the legendary Jack Bogle, gave us the perfect mental picture for this. Remember that needle in a haystack we talked about? Well, Bogle said, why on earth would you waste all your time and energy hunting for that one tiny needle when you can just buy the whole haystack? That's what owning a broad market index fund is all about. Okay, so you've got your simple, boring, effective plan all set up. Fantastic. But now comes the final boss battle, and that's protecting your plan from the never-ending onslaught of noise, especially the noise coming from the financial media. Look, we've got to be brutally honest about the business model here. The job of the financial media is not to make you a better investor. That's not their goal. Their job is to get your eyeballs glued to a screen so they can sell your attention to their advertisers. And what grabs our attention more than anything else? Fear and excitement. The two very emotions we're trying so hard to keep in check. I mean, you've seen this headline a million times, right? Market plunges 500 points. It's practically screaming at you, and it's designed to do one thing. Hit that panic button in your limbic system, give you that knot in your stomach, and make you think, oh my gosh, I have to do something now. But hold on. Before you do anything, you have to pause and ask the single most important question you can ask. What does that number actually mean? Because a number without any context, it's just meaningless noise. Let's put this into perspective. If that 500-point drop is talking about the Dow Jones, well, that's only a drop of about 1.3%. It's basically just market noise, a totally normal day. But if that same 500-point drop is for the S&P 500, that's a massive 9% crash. A huge deal. So the same headline can mean something totally insignificant, or it can mean a major market meltdown. Context is everything. And there's actually a name for this little media trick. It's called denominator blindness. It's when they flash a big, scary number in your face. That's the numerator, the 500 points. But they conveniently leave out the denominator, the number that actually gives it meaning, like the total value of the index. And I'm telling you, once you learn to spot this, you'll see it everywhere. And all of this brings us right back to where we began this whole conversation. The scary headlines, the ups and downs of the market, the economic forecasts, those aren't the main threat to your portfolio. The biggest, most dangerous, most persistent threat to your financial success is your own impulsive, emotional, savanna-wired brain. It's you. So the next time you sit down to think about your investments, I want you to ask yourself one final question. Are you building a plan to protect your money from the market? Or are you building a plan to protect your money from yourself? Because honestly, the answer to that question will make all the difference in the world.